Good afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review. My name is Benjamin Goh, the Head of Research and Investor Education here at SIAS. With me is, of course, our Senior Technical Analyst, Sunny So, who is in the background. He'll be coming on in the later half of the show. All right. Now, the most important slide on the deck is, of course, the disclaimer. So, as usual, SIAS, as you know, is a registered charity. We're not licensed by MAS. Therefore, whatever that we talk about today, especially specific stocks or companies, cannot be misconstrued as a recommendation. So, do you see a licensed financial professional before taking any kind of action in capital markets? Now, so for those of us who did not manage to join us last week, we are moving on to a pre-recorded format simply because the original intent of the SIAS, but the weekly market review is basically to have a very quick, snappy, and bite-sized kind of learning pathway. But over the months, it has grown to be a full 1 hour long kind of session. So we've got feedback to kind of move back to a more snappy format. Hence the pre-recorded format. Now, we do understand that some of you will have questions at the end of today's session. We do have a forum for you to ask questions. This is the SIAS. It's monthly held in the evening. The next one is on the 12th of April, Wednesday, 7 p.m. Now, just to be sure we're on the same page, this is exclusively for SIAS members. So you will need to be a SIAS member and to register to choke your slot. Now, the good thing is, obviously, to be a SIAS member is super cheap. It is $1 per month, $12 per year, which means that this is probably the cost of an upsized Burger King Happy Meal for $12 a year. And you get access to a lot more membership benefits in addition to the SIAS session that we have every month on a Wednesday night. So do join us if you think our workshops as well as all these events are helpful for your learning pathway. Now, just to get on to today's content, very quickly, a couple of news articles that came out over the weekend. JP Morgan is pretty sure that there's going to be a recession by the end of this year, yes, 2023. Now, the investment hypothesis is that the continuous string of interest rate hikes as well as the quantitative tightening have already broken the back of inflation, quote unquote. This is from a analyst in JP Morgan. So just a bit of clarity here. Interest rate hikes, we do understand simply because the Fed funds rate is now hovering about 5%. And that has been on the back of a continuous string of hikes by the US Fed. Now, the quantitative tightening part is simply because interest rates are now higher. That's why, obviously people are going to be borrowing less money because of the higher cost of funding. And of course, banks are becoming more selective in how they lend money out because obviously they only want to lend it to people who have got good credit. So in a way, the money supply has tightened. This is obviously restrictive monetary policy, which is the correct prescription for high inflation. Okay, so we're going to come back to this in a minute. Now, the analyst from JP Morgan says that we are going to be seeing a cumulative negative effect on the US economy and by extension, the global economy really soon. We have not really seen it yet. What we have seen is that a slight moderation of top-line inflation numbers in the US, but also the the jobs report have certainly been quite bullish, or rather supersedes analyst consensus more often than not. But this analyst is saying that all those many months of interest rate hikes, we're gonna see the impact real soon. This analyst also suggests that by the third quarter, specifically in September, the US Fed may start cutting interest rates simply to moderate interest rates, as well as because by that point in time, this analyst thinks that the inflation fight would be roughly over, and the Fed will need to focus on trying to land the US economy into a soft landing. The recession is inevitable by the end of the year, quote unquote, by JP Morgan. And he suggests that for the high yield credit spreads, we can expect a minimum of 800 basis points. No, what is 800 basis points? Basically, it's plus 8%. That means whatever the US Treasury risk-free rate is, just slap on that 8%. That would be the average spread or average yield for junk bonds. All right. So high yield credit is basically junk bonds, or what you call high yield bonds. Obviously, for companies like, for example, just a very quick example, Blockbuster in the US, that has been a junk for a long time, one of mine stocks. It is going to be a drastic change in their circumstances if interest rates on their bonds are now going to be so high. It's going to be very hard for them to raise funds. But anyhow, the default rates might jerk up to around 6% by the end of this year. Okay. This is the beginning of week 3, survival mode after the banking crisis in the US, as well as 2 weeks after the takeover of Credit Suisse by UBS. According to Bloomberg, US banks right now have a US $620 billion of unrealized losses on their balance sheet, stemming from available for sale as well as held to maturity securities. Okay, just a quick primer. Held to maturity securities, basically, in general, long-term bonds, anything that is, let's say, 5-10 years US Treasury bonds, held to maturity securities. The idea here is that because the bank needs to hold some assets as a buffer, they might enter or invest in all these long-term, low-risk bonds. And because they're held to maturity, the bank is not expected to sell the bonds unless it's, like a crisis. So therefore, under international FRS, international reporting rules, accounting rules, the held to maturity securities are not marked to market. So the day-to-day or minute-to-minute price volatility, so on and so forth, all those unrealized losses or unrealized gains do not actually show up in the financial statements of the banks, right? So this is based on globally accepted accounting rules. However, the available for sale securities are marked to market, and therefore the losses or gains do show up in financial statements, at every quarter. Okay, so we're gonna kind of remember that for a minute. Going to come back to this. Now, the problem here, right, is that we do not have a linear relationship between what happens in terms of monetary policy, fiscal policy, as well as what happens in capital markets. So the dynamics tend to unfold in a non-linear fashion. Hence, the implosion of Credit Suisse 2 weeks ago was really a big deal. And the fear then, as it is now, is like this. The constriction of credit leads to declining asset prices. That means you see the banks are now facing a funding squeeze. They need to pay higher interest rates for funds, cash basically to lend out, and therefore they're also a little bit more sensitive to who they lend money to, and therefore it's more expensive to borrow money to buy assets. Therefore, asset prices are declining, and we'll be talking about that in a minute. That might also lead to non-performance of loans, which leads to more credit constriction. So as you can see, right, it's kind of a round and round catch-22 kind of thing. Now, the whole problem here is that we are now into the very much into a environment where we have got elevated inflation. So because of high inflation, obviously these depositors, especially for people like you and me, normal people, some of us are gradually withdrawing our bank deposits and investing in higher yielding instruments. For example, money market funds, as well as other short-term investments. Now, if you take the Singapore context, we already have seen a trend of investors withdrawing their money from banks, as well as divesting from Singapore REITs and investing in something like the Singapore savings bonds, right? So those are basically almost, I would say, theoretically zero risk government securities, Singapore government securities that give at a maximum 4.5% yield. So obviously, zero risk for 4.5% beats putting money in a fixed deposit for less. right? So we've seen that trend happening for longest time already, not just in Singapore, but also in the US. Now, the banks, obviously, because people are withdrawing their deposits and are buying all these instruments, all these products, the banks naturally are facing a funding squeeze. So the deposit base is shrinking. And therefore, in order to attract deposits, they need to offer higher interest rates. Okay. See, the problem here is that you need to, or rather the banks need to offer high interest rates to attract deposits, but yet because some of the loans that were previously offered to clients, they were fixed at a very low interest rate, before the whole problem of inflation. That's one. And two is, of course, the banks themselves might also invest in all these help to maturity securities that previously also offered a very low yield. So as you can see, the revenue for this kind of products, beg your pardon, as well as the bank's own investments, at some point previously very low yield because we have a low inflation environment, but now these things don't cut it, as well as the fact that the banks will now have to pay higher for deposits, high interest for deposits. Now over time, this problem will lessen, simply because as the banks issue new loans, they will now be pegged at high interest rates. When the banks buy or invest new securities, again, those will be the higher yielding ones. So over time, this problem will go away. But the net is obviously in Singapore as well as in the US, you can see that although the net interest margin or net interest income for the new loans are going up, but then you still have a legacy issue of all these old products here. So that's leading to a squeeze in the bank's balance sheet as well as profitability. Now, the other problem is that when yields go up, so now the Fed funds rate sits about 5%. So higher interest rates, mathematically, there's no way around this, basically will lead to more losses on the available for sale bonds that the banks actually own using their own money on the balance sheet. Now, this is a mathematical certainty because the yields as well as bond prices have an inverse relationship. So when the yields are up, bond prices are down. So you have got all these losses. Now, these are not going to affect the held to maturity securities that the banks have, because there's not mark to market, but available for sale bonds are mark to market. And of course, that will show up at some point in the bank's financial statements as losses. Okay. Now, the other factor we're going to talk about is that both in the US as well as Singapore, as well as many other countries, the government has put in place a deposit insurance scheme. So if the bank, 倒闭, goes bankrupt, closes doors straight away, then this insurance scheme will, of course, reimburse depositors up to a certain amount. Now, in the US, this is USD 250K, that's $250,000 US. In Singapore, it's 75K Sing dollars. Now, this is on a per bank basis, not on a per account. So if you have got 10 accounts with POSB/DBS altogether, again, the total is 75K Sing dollars. Now, the challenge is, of course, for depositors with money in excess of all these insurance caps, what is going to happen is that if, let's say, there's the first sign of problem, the excess money is not going to be insured. So obviously, these depositors will very quickly withdraw their excess funds at the first sign of trouble at any bank. Now, this has been happening in the US. Already, you have seen a string of closure of US banks. Net, the community and regional banks in the US have lost more than $100 billion worth of deposits as of middle of March this year. Now, this is not to say that the community and regional banks have run out of money. No, not really, because the depositors have pulled money out from the smaller banks, and they have placed their deposits with Wells Fargo, JP Morgan, Citigroup, so on and so forth in the US. So the big banks are basically getting more of the deposit base, from depositors moving money from these smaller banks. Now, since it's still within the US banking system, all these extra funds are basically recycled back to smaller banks via the Fed. Now, the Fed has got a couple of programs. First is the discount window. You can think of this as the overnight lending program. So, the smaller banks can always borrow money from the Fed discount at the Fed discount rate, sorry, using this window. Then, of course, the Fed has also rolled out a new bank term funding program, basically to add liquidity to any kind of bank which, requires funding. And, of course, through private deals. So, I believe the Fed has injected $30 billion into Republic First, I believe, basically just to make sure that the bank has got sufficient liquidity. So not to say that the banks have run out of money. I mean, they can still tap liquidity from the Fed, so that's not really an issue. All right, now this is basically a chart that shows the total bank deposits on the right-hand side has been coming down quite a fair bit. So people again pulling out bank deposits to invest in higher yield products. And then the one in the middle is basically the reserves held by the banks. Obviously, deposits are moving out, so reserves are coming down. And on the extreme left is the overnight reverse repo facilities offered by the Fed. Now, as you can see, it's skyrocketed simply because the smaller banks now can tap into all these overnight reverse repo facilities, basically to get liquidity on a very short-term basis. So all this is in line with the overall narrative in the US banking system. Now, this is a show which my wife saw recently. She said it was totally bonkers, a bit crazy, like, hard to believe. But why am I bringing this up? So everything, everywhere, all at once. What's been happening is obviously the strains in the US financial system is showing up quite clearly. It's not just one data point. It seems to be a couple of data points are showing up at the same time. So as per the first slide, interest rate hikes as well as quantitative easing is having an impact on the US economy and by extension, the global economy. So according to UBS, late payment rates on both prime and subprime auto loans that were previously packaged into asset-backed securities are reaching their recent peaks in 2016 and 2018. Now, obviously, this is not as bad as 2008, 2009, because at that point in time, again, the late payments as well as default rates for asset-backed securities escalated to such a point where the asset-backed securities basically failed. Okay, so we are not at a point yet, but as you can see, the late payments are already creeping up close to their recent highs in 2016 and 2018. Now, the year now is 2023. Very bad timing. Basically, it suggests that the people are running out of cash. So they are making, or rather, they're late payments, so on and so forth. Again, we have to wait for the next publication of high-frequency data, such as credit cards, to basically track that. But as you can see, this is creeping into the economic data that's coming out. We already can see that in a couple of metropolitan areas in the US, commercial real estate values are beginning to fall. Right, that's also in line with a population shift. So a lot of the metropolitan areas in the US are losing people simply because the birth rate, I believe, right now is I think it was 1.4% or some historically low number for the US. The premium spread on high yield is already moving up, but not to the extent of the 800 basis points yet. But again, I believe I've got a chart here. As you can see, this is the yield spread on the junk bonds, right? High yield spread. Now we are at about, 3.75% on the aggregate basis. So it has spiked quite a fair bit in the last few months. Not to the extent as in the middle of 2022, where it hit about 4.5%. But as you can see, the escalation is quite concerning. All right. Now, moving on, news that just came in this morning when I stepped into the office. OPEC Plus has made a surprise announcement to cut oil production by up to 1.1 million barrels a day. Again, in conjunction with earlier in March, Russia had announced that it was reducing a supply of oil by 500,000 barrels a day. So net from from July onwards, a total of 1.6 million barrels of oil a day will be taken out from the market. So that is quite unexpected. Now, if we were to look back at the news feed from all the way, I think it was October last year, the Nigerian Minister of State for Petroleum actually said that OPEC Plus wants a oil price at around $90. And after this morning's news that came out, the market opened in Tokyo, obviously, and the oil futures have spiked. As you can see, oil futures have spiked from one business day ago by about 5+%. Now, the Brent crude oil is trading at 85.21. That was about an hour and a half ago. WTI is now trading 80.7. Now, if this happens or it just carry on for a sustained period, then obviously we're going to see a creeping up of the CPI, the Consumer Price Index. Just a week or two ago, I was reading that gas prices in Europe at least have fallen quite a fair bit. Simply because at the beginning of the Ukraine war, it spiked, and we're wondering whether or not Europe will run out of gas in the winter. They did not do that, and gas prices fell quite dramatically, but I think it's going to be creeping up again. Now, oil prices basically dictate, or rather is the leading indicator for all other types of energy products, things like kerosene, aviation oil, LNG, so on and so forth. They all take the cue from Brent as well as WTI. So if this spikes about 5+% overnight, then obviously the other products are going to be spiking. I checked the futures earlier this morning. That is true, but whether or not it's going to be on a sustained basis, we don't know yet. Now, the other shoe that may drop is obviously when oil prices are this high, then if JP Morgan is what JP Morgan says is true, that we're going to be heading into a what you call a recession by the end of the year, that's going to be a problem. So it's not the end of the year for oil, but as you can see, it is not the highest. The highest was reached in recent times, $140. That was just before the Great Financial Crisis. Now we are at about 80-ish. So not the end of the world, but obviously it's going to be another problem that we need to deal with. Okay, so with that, I'm going to end the slides here. I'm going to pass the time over to our senior TA to talk about the charts. Very warm welcome, Sunny.
Okay, thanks, Ben. So thanks, Benjamin, for the comprehensive review of what happened last week. We will be analyzing further into some of the evidence of what Ben mentioned just now on recession as well as on oil. So this is a recap on the summary of economic projections by FOMC on the 22nd of March. Okay, so as you can see over here, one of the first table in the economic of projection is a change in GDP, and they expect at the end of 2023 here, the GDP is likely to be at around 0.4%. So this is in percentage from 0.4. So if you are going to refer to the quarter-on-quarter GDP growth, so the previous one that we have was in end of 2022, which we see a 2.6% GDP growth as of last year for US GDP. So from 2.6% to reach the projection of the FOMC to 0.4% at the end of 2023, we are expecting a negative 2.2% of negative GDP growth, which is likely going to happen in the next 3 quarters. So what that means is in academic terms, what we determine by a recession is 2 consecutive quarters of negative GDP growth. So we are expecting to see at least 2 quarters that we have a negative GDP growth going forward to reach the final projection of 0.4 at the end of 2023. So this is what coincides with what Ben mentioned of what JP Morgan is projecting, that we are likely going to see a recession this year. So things are in line. So do hold your horses if you are trying to sort of go all in into the market. So the recession is coming, and there may be some nasty surprises from now to the end of the year. Next, we move on to the all-famous dot plot chart, and this is over here at the end of 2023. Most of the Fed officials here have predicted that we are likely to see peak interest rate at an average of 5.1%. So
sorry, Sunny, to jump in. Are you sharing your screen? I can't see your screen.
Oh, okay. Let me reshare. Okay. So you're sharing. Is it okay now?
Yeah, looks good.
Okay. So just let me recap what I said earlier. So we are going to do a recap first on some of the further evidence from what Ben went through just now. So one of them is the summary of economic projections, which is released on 22nd of March by the FOMC committee. So in that projection, that first table that we see is the projection of the GDP at the end of 2023, 2024, and 2025. So the change in GDP is expected to be at 0.4 in percentage form at the end of 2023. Now, if you compare this 0.4% GDP growth and then the last reading that we have, which is 2.6% over here, which was at the final quarter of 2022, that is a negative 2.2% growth that we are going to see in the next 3 or 4 quarters going forward. So what does that mean? That means that we are likely going to see 2 or 3 quarters of negative GDP growth going forward. And in academic terms, what do we mean by recession? That is what we say by 2 consecutive quarters negative GDP growth. So this is in line with what JP Morgan said, and it's also in line with what the Fed members are projecting as well. So there is a very high possibility, if not a certainty, that we are likely going to see a recession in the next few quarters. So next, I move on to the dot plot chart, the all-famous dot plot chart. Most of the FOMC members has predicted an average or peak interest rate of around 5.1%, and we are now already at the 5% point. So we are likely going to see a final 25 basis point rate hike to the end of the year. So if we refer to the CME Fed Watch Through, which is the projection of the rate hike or the Fed fund rates going forward, based on the futures pricing, you can see that the next release of the FOMC rate announcement is on the 3rd of May. And at this moment, market is pricing in a 50-50 kind of probabilities that we are going to see another 25 basis point hike in May. So things are still up in the air at this moment, according to the Fed funds rate projection. So let me go to the economic data that will be published this week. Tonight, 10 p.m., we will be expecting the Ism Manufacturing Pmi Data. So the previous reading we have is 47.7. The consensus now we have is 47.5. So we are expecting a slight further contraction in the economy by 0.2% for this month's reading, which is referencing the March month. Okay, and then at the end of the week on Friday, we have the unemployment rate as well as the non-farm payroll, which is the key data, one of the key data that Fed is looking at when determining their interest rate hike. So the previous reading we have is 311,000 for the non-farm payroll reading, and we are having a consensus reading now of 238. So we can see that non-farm payrolls are coming down, which is good for inflation, because that would mean that inflation should be controlled if the non-farm payroll data is coming down. On the Singapore side, not much of a news for this week, or not much of a data being published this week. Similarly, we have the PMI data tonight at 9 p.m. as well for Singapore side. On Wednesday, okay, nothing much on Tuesday, but on Wednesday, we also have the S&P Global PMI data, and we also have the retail sales coming out for the Singapore economy. We also have the COE data coming out also. If you are trying to buy a car, you might be interested to see on Wednesday, 4 p.m. what is the latest COE prices. Okay, I think it's likely going to go up further. Okay, so let me move to the charts now. So a review. So we have sort of completed the first quarter of 2023, and how has the US index performed in the first quarter. So as you can see, I dropped out a summary over here. The main increase or the main rise in the equity indices is led by the Nasdaq Composite Index, which is the tech-heavy index. So that means the tech sector is sort of leading the rally that we see this year. So for the Nasdaq, it gained 16.8%. It's the largest quarterly percentage increase we've seen since 2020. So 16.8% is a very impressive growth. If you just invest for the first quarter of this year, you haven't annualized that. That is the 16.8% gain for you in the first quarter of 2023. Next, we have the S&P 500 rising 7%, rebounding from the 20% drop that we see in 2022. So we sort of more or less clawed back close to half of what the 2022 losses or 2022 drop in the S&P 500 index. Then we have the Dow Jones index, which is not that optimistic. It is only up 0.4% this year. So a lot of big companies' share price are not performing that well. So the rise in equity markets now is all mainly led by the tech sector. So is that going to continue for the next quarter? We will have to see how the interest rate is, and of course, we will update you here on the weekly market review as well. So let me just pull this away, and then let's analyze on the technical part of the Dow Jones index. So we can see that we reached the low on the 15th of March, and that was a higher low compared to the October low that we see in 2022. So we have seen a higher low forming. So if you are saying that market is going to a bull market right now, a recession is not going to affect how the equity index is going to perform. Then likely we will need a confirmation of a higher high in the resistance point of view, okay, in the resistance trend as well. So we are still quite a bit far away from forming a higher high. That means we need to see a high that is higher than what we see in December at the 34,700 point reading. So for now, if I look at the MACD indicator of the Dow Jones Index, we can see that somewhere on the 25th of March, the MACD line has crossed above the signal line, and the MACD histogram has also turned positive. For the last few trading sessions, especially on Friday, with that 400-point ups in the Dow Jones Index, it is showing us that the momentum in this uptrend is actually gaining strength, hence the divergence of the MACD line away from the signal line. So that is the positive uptrend momentum reading we have from the MACD indicator. On the RSI side, we have the latest reading last Friday closed at 59 points. So it's also showing healthy uptrend momentum above the 50-point neutral mark, as well as still some point away from the 70-point, which is the overbought signal. So where is the Dow Jones likely going to hit? According to these two, MACD and the RSI indicator, we are likely to trend up further. And the first resistance level that we will see is to test the year-to-date high, which is a double top formation that you see over here between the January and February period at the level of 34,281. So with this strong momentum indicated by these two indicators, I will not be surprised if we retest the year-to-date high at 34,280. Of course, you have the red downtrend line over here connecting the peak that we see at the beginning of 2022 to the high at the end of 2022, and then retested that in the first quarter of this year. So we are likely going to retest the downtrend line and also the year-to-date high of what we see this year in January and February at 34,280. If we are able to break this year-to-date high, that means we will be likely to form a higher high on the resistance side. That will confirm the resumption of an uptrend that we are going to see going forward into the later part of this year. So we are very close to a beginning of a long-term uptrend formation. So we still need that confirmation to come in the next few weeks or months to confirm that uptrend. So next, let me move on to the S&P 500, which rose 7% in the first quarter of this year. We can see that the S&P 500 actually breached the top part of the top upper bound of the Bollinger Band, and also trying to test the resistance that we see somewhere in the December period last year, which is at the level of 4,114 points. So the close of last Friday S&P 500 at 4,109 points is very close to that point. If we are going to break this double top kind of formation, which is a strong resistance level, that will mean that the uptrend is likely to go further, and then we might be likely testing the high that we see somewhere in August here, which is the level of 4,325 points for the S&P 500 index. So if we look at the indicators for further evidence of whether this uptrend momentum will continue, we also see that somewhere around the 22nd of March, the MACD line actually crossed above the signal line. So a crossing of the MACD line above the signal line is an inflection point or a reversal that's likely to happen. That was also somewhere close to the low that we saw on 13th of March at 3,840 points. So in the past few sessions, you can see that the MACD histogram has been sort of gaining strength and gaining momentum, thereby telling us that the prices that we have now has the sort of a pretty healthy and strong momentum according to the MACD indicator. On the RSI as well, we see that the latest reading as of last Friday close is 62.86. So this is also a healthy uptrend momentum kind of a reading, just 8 points short of the overbought signal at the 70-point mark. So we expect the S&P 500 to rise further, and then sort of a cross above the double top formation that we see over here in December. And this double top as a resistance level may have a change in polarity and become a support for the S&P 500 going forward to retest the August high at 4,325. So we will be seeing some resistance here because of the double top formation, as well as the RSI may also go into the overbought territory, thereby slowing down the momentum of the rebound that we see so far. But definitely we will be seeing some consolidation over here at the 4,000 handle, 4,100 level, which was the close of last Friday. Next, let's move to the Nasdaq Composite Index, which has the 16% growth in the first quarter. So this is what we see. We are also seeing a higher high forming on the Nasdaq Composite Index. Hence, some of the technical analysts out there are calling Nasdaq to have entered a bull market again. So what do we determine by a bull market again? You can see that On the low of October, we have the lowest point in 2022. Then we have sort of somewhere close to the lowest point as well in December, which is slightly higher than October point. So that means that this is a higher low. And of course, in the March period this year, we also have a much significant higher low forming. So if you draw an uptrend line along here, something like the green line that I've drawn over here, this is a formation of an uptrend support line. So if you're going to form a resistance line going upwards over here, that will likely you have to connect the low, the high of December as well as the high of February, and the next formation of the high somewhere in April this month, and that would sort of give us a range, uptrend range that we will see for the Nasdaq Composite Index. Now, analyzing the momentum of the Nasdaq Composite Index, if you look at the MACD indicator, we have crossed the zero baseline on the 20th of March, and thereby we can see that there's a lot of healthy uptrend momentum pushing the Nasdaq up further. Okay, so this uptrend momentum is still sort of gaining strength as the MACD line is actually diverging away from a signal line, and that's confirmed by the MACD histogram as well. So we will not be surprised if the Nasdaq Composite Index retests the next level high, which is somewhere here in the June of last year, and that's at the level of 12,555 point level. So 12,500 will be the next target for the Nasdaq Composite Index. The RSI is also suggesting that we have very strong uptrend momentum as well at the latest reading of 65.77. So just very 5 points away from the 17-point overbought signal, which is what we experienced in February, and hence the ABL retracement. So if we are going to retest this level 12,269, which is the year-to-date high in February, as well as the 12,500 points, which is the high in June last year, then definitely the Nasdaq Composite will also face consolidation around this area, using the double top here, as I suggested earlier, as a support, and then sort of let the RSI retrace from the overbought territory of 70 points before it starts to gain further momentum to retest the 13,181 points towards the later part of the year. So yes, the Nasdaq is leading the bull market rally now. Okay, so the S&P 500 as well as the Dow Jones Index might follow later on, but we are waiting for the confirmation for the other two indices. So next, let's move to the Asia side. On the Hang Seng Index, we also see sort of a mini rally the last few days, or last 2 weeks, I would say. So on the indicator side, the MACD indicator actually crossed above the signal line on 23rd March. So do note that for the MACD indicator, if the MACD line and the signal line is below the zero baseline and a crossover happened below that, and it crossed above the zero baseline further from there, that would mean that this is a very strong uptrend momentum that we are seeing. So I will not be surprised if the Hang Seng Index retests the year-to-date high that we see on 27 January at the price level of 22,700. For the latest RSI index point that we have now is 20,325 points. So this means that we are likely going to see, I believe, it's close to maybe a 20 percentage point rise here. So let me just put in the indication over here towards this level. So sorry, so it's about 11% rise here to retest year-to-date high at sort of 22,712 points. Okay, so if you look at the RSI for the Hang Seng Index as well, above the 50-point neutral mark, the latest reading we have here at 54.18 shows that there's uptrend momentum, though that momentum may not be strong, which also means that there is a chance for us to get in at the low of today, or even the low of last Friday, to play the rebound back up. So as long as the RSI stay above the 50-point mark, the uptrend we see here is still intact, and the MACD line and the signal line crossing above the zero baseline will give the Hang Seng Index more strength to push it further up to retest the year-to-date high that we see in January this year. Next, let's move to the Hang Seng Index. So Hang Seng Index, of course, this last week we had the news of Alibaba splitting into 6 different units, possibly to sort of give the government regulators more assurance that they are not in the monopolistic nature. So thereby it pushed the Hang Seng Index up quite a bit, and you can see that the momentum on the MACD indicator, the MACD line and the signal line, is actually pretty strong over here. So I'm more confident of the HS Tech Index reaching the peak of this year, which is the January high at 4,825 points as compared to HSI. So this is just a relative comparison. If you look at the RSI index at 55.7, it's also slightly a stronger reading than the HSI index. So thereby I have more confidence that it's likely to push up further. So if Alibaba is the first tech company that is going to announce this kind of a split, which can unlock more value for the Alibaba Group share price, then definitely we might see some of the other tech companies announcing the same kind of a strategy as well, which is in line with what the Chinese regulators want. So that may provide further catalyst to the HS Tech Index going forward. So let's move back to the local market, STI Index. STI Index latest reading now we have at 3,278 points, still a positive day today, up about 0.6%. So where is it likely going to hit? So we see that the MACD indicator is still gaining strength with the MACD line above the signal line, and we see that this today's MACD histogram is actually stronger than the previous Friday reading. So that means that we are likely to see a continuation of the uptrend that we see since the low of 14th of March at the price level of 3,094 points. So the next resistance level, of course, this double top, which we have talked about quite a few times last year as well in the weekly market review. The November high that we see over here around the 3,308 points level was tested once again in January. We managed to break through that in close to the end of January, the early part of February, to reach a high of 3,408 points. That's the year-to-date high that we see for the STI index this year. So we have also not reached the higher bound of that Bollinger Band as well. So that means there's more room for the STI to move up further. The RSI indicator of the STI index reading at 59 is showing healthy uptrend momentum. So we expect for at least this week and maybe next week, we will see that STI likely to trend higher to maybe break the 3,308 points resistance, double top resistance level, and probably maybe use that as a support going forward, as following a change of a polarity on the resistance side to a support side, and then use that as a consolidation or a support platform to retest the 3,400 points level for the STI index. Okay, so that is the coverage of the major indices that we have, the 3 US index, the Hong Kong index, as well as the Hang Seng Tech and the STI index. I'll cover a bit on the oil price as well, as we have seen this morning the news of the OPEC output cut. We saw a gap up on the oil price. So the latest oil price reading we have is around $79.80 level. If you are thinking of whether you should be chasing this gap up, my suggestion would be to hold your horses, because year-to-date high that we see is around $82.6 US dollars level. So we are very close to that level, and if we are going to test this level, as you can see over here during the January period, it's likely going to hold a lot of resistance level. From the period of 18 Jan to 20 Jan, we see sellers coming in, pushing the price down. So it has also breached above the upper bound of that Bollinger Band. Likely it is going to come back downwards, although the MACD is still showing a great strength. Okay, that's because maybe we have not tested the 82.6 level, which is the high that we see this year. But once we touch that point, I expect resistance to start coming in. And that will also mean that the RSI at the current reading of 64.7 now still has some room to grow to reach the 82.6 level, and then that is the first resistance that we see. So if you are thinking of getting into oil prices for the uptrend, I would suggest that you relook at the current price that we have now and look at some of the support level, which might provide you with a sort of a better safety margin when trading into oil prices, which is a very volatile commodity. So the support level that we have is here in September, okay, 2022, that is the 76.28 level. So probably around the median or the middle price of what we see this year, as well as you can use the 20 days moving average at 72.46 as guidance of going back into the oil price rally that we see since the low of 20th March. So I think the gap up here will likely close in the next few days once we test the 82.6 level, and then have a consolidation around the $76 level before we see what is the next suggestion or what is the next projection from the OPEC committee to see how bad the recession we are going into and if they are likely to cut their output further. So with that is the end of this week's video for the weekly market review. We will still be back next Monday. So I hope to see you in the next video in next week's weekly market review.